Thanks to forward guidance from the Federal Reserve / Jay Powell, markets have been hyper-focused on the timeline in which the Federal Reserve will actually cut rates in 2024, or if they'll cut rates at all in 2024 at this point. And a couple cases have been made for a rate hike as well. Jay Manchin here, back with another video, guys. Today, we're going to briefly touch on why rate cuts have been pushed back and potentially thrown out the window altogether. We're going to touch on the latest FOMC meeting, the latest inflation numbers, the labor market, GDP, and a little bit of housing. Let's jump right into it. Now, at the last FOMC meeting, some could argue that it was dovish, some could argue that it was hawkish. I think it was right in the middle. As a Federal Reserve chairman, that's probably what you should try to do, is like err along the side of caution by staying in the middle, not putting too much credence on any action, because you might have to readjust and change the course of that action. So as expected for the June FOMC meeting, the Federal Reserve held rates where they are at between 5.25% and 5.5% on the Fed funds rate.
The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace.
And as you know by now, the Federal Reserve's dual mandate is to maintain maximum employment and to maintain price stability. And so they've been hyper-focused on these two data points when it comes to adjusting monetary policy appropriately. Starting with the latest inflation numbers, the latest headline CPI year-over-year number came in at 3.5%. The latest PCE number year-over-year came in at 2.7%. So inflation is still stubborn and sticky, icky. And so being a data-dependent Federal Reserve means that because inflation is so sticky and there are real risks of inflation moving back to the upside, it wouldn't make sense to cut in the near future at all. Because if you think inflation is sticky now, if they were to cut in July, that was my assumption before, that they would cut in July, but as more data got released, I did say that could change, and it for sure changed. If they cut in July, inflation will be sticky as bologna on the wall. I don't know if you guys ever threw bologna on the wall when you were kids, but it sticks pretty well if you throw it hard. If they were to cut in July, in effect, it's almost like locking in that inflation rate at these sticky levels, which we don't want. Now, if we look at the true inflation rate, which updates daily and is a real-time metric, and they use 10 million data points, it was under 2% in February. Since, it has been climbing pretty steadily. Now we're at 2.2%. And so by every inflation metric, it is very sticky, and there's a huge risk of it climbing again. And once again, we don't want that. The thing is, inflation at these levels, it's not killing the overall consumer in general. Yes, you have some people who are more hurt than others by higher prices, but in general, the consumer still looks healthy on paper. So some would say this is still manageable inflation. So if the consumer is still spending pretty healthily and the Federal Reserve were to cut rates, that would only exacerbate these inflationary problems and once again push it to the upside. Speaking of the consumer, the labor market is also softening but not weakening. It's also not burning hot anymore either. In April, we added 175,000 non-farm payroll jobs. And the unemployment rate is sitting at 3.9%. And it's been in this range of 3.7 to 3.9% since effective, August 2023. So we've been in this tight range for a while. And so a lot of folks were curious if we were going to continue to add over 250,000 jobs every month in the labor market. So it was kind of a refresher, depending on who you are, I guess, that we've only added 175,000 jobs and not 100 or 250 or 300. And so you're right in the middle, so it's softening, but not weakening. And wages are holding pretty steadily as well. And so we're not at risk of a wage price spiral type environment, which effectively is just wages go up, so prices have to go up, and then wages go up more, so prices have to go up, and it's a self-reinforcing loop. So that's what a wage price spiral is, and we're not at risk of that at the moment. And so if we look at this inflation nowcast, which is generated by the Cleveland Fed, they actually are expecting May's CPI report to move higher, as well as the PCE report. Now, to briefly touch on housing, I still don't think that there's going to be any type of housing collapse. I know a lot of people are still calling for a collapse of the housing market, but it's just not going to happen, guys. At least the way things are looking right now, it's not happening. Mortgage rates are still above 7%, and we still have a good amount of activity in the market. So it hasn't stalled out by any means. And the people who are buying, they're buying. Simple as that. It may be a little tougher for first-time home buyers, but for the most part, a lot of people are buying, and we've seen an increase in cash transactions as well. At the end of the day, it is a supply problem, as I've been saying for like a year and a half, 2 years, however long I've been saying it at this point. And unless we have millions of units coming to the market at one time, ready to be sold, prices won't really get any relief in the near future. And we will not have a housing collapse in the near future. Not saying in the future, but in the near future, there will be no collapse in housing and home prices. So if you're a real estate investor and you've been sitting on the sidelines, go ahead and buy, man. If you can buy, you got the resources to buy, go ahead and buy right now. You're good. Not financial advice though, remember that. Now with GDP, we're growing year over year on a quarterly basis about 5.5%. If we're growing at 5.5%, if we already have excessive economic growth, it makes no sense for the Federal Reserve to cut rates to spur on more economic growth. Because once again, that will lead to higher inflation, which would start to hurt the consumer, which leaks into the labor market, which could push us into a recession. And so, all things considered, with GDP included, it doesn't make sense for the Federal Reserve to cut rates at all until we see a huge shift in the data. Now, some folks, even Fed governors, are not ruling out the possibility that there will be a rate hike in 2024. Like Neo Kashkar is saying that rate hikes are certainly not off the table. Or Larry Summers saying that we have to take serious the possibility of a rate hike in 2024. I don't know if I'm quite there yet, but I'm erring on the side that it would be prudent for the Fed not to move, considering where data is currently. It would make more sense for them to hold rates where they are, let things play out a little longer, and receive more data to help them determine the appropriate path of monetary policy. Now, why would they hike rates in the first place? Well, one reason is excessive growth, i.e. too much growth. Inflation keeps moving to the upside despite them holding rates where they are. Or we start to have a hot labor market again, which means inflation follows to the upside and they're holding rates where they are. And so those reasons in general will be why they actually raise rates in 2024. Like I said, I think they're going to hold unless inflation, the CPI and PCE specifically, those numbers come in under 2.4% or something like that, in that range. If we got down there, I can see them cutting. Other than that, doesn't make sense. Because the real Fed funds rate, although historically restrictive in terms of where we are currently, it doesn't feel that restrictive to consumers or markets in general. And when I say real Fed funds rate, I just mean the nominal rate minus inflation. So you could use PCE or CPI, whatever that number is for you. So for easy numbers, if we just use CPI, which came in on that headline year over year number at 3.5%, inflation, the effective rate sitting at 5 1/3, 5.33, we're looking at a 1.83 real Fed funds rate. Anything over zero is considered restrictive. And so this, in theory, should be restricting economic activity way more than it is. But obviously, it's not. To conclude, are they going to cut rates? Are they going to hike rates? Are they going to leave them the same and do nothing? I don't know yet. And here's the beautiful thing. The Fed doesn't know either. And this is why it's important to keep up to date on new data that's been released on a daily basis to help determine what the most likely path of the Federal Reserve is in terms of monetary policy, which gives you insight on how to construct your portfolio in advance. At the end of the day, you can make a case for the two actions or the one inaction. The two actions are rate cut, rate hike, or leaving them alone. You can make a case for all of them at this point in time, which means we're at a time of uncertainty. Can't cut too soon, can't cut too late. And you can't hike prematurely if you decide to do so. And also, you can't succumb to analysis paralysis even if you're the Federal Reserve and do nothing because you're a little confused about where the data is going to be in the next few reports. Anyway, guys, I hope you enjoyed this quick hitter as always. I hope it provides you with some type of value. If so, leave a like for me, leave a comment, leave your thoughts. If you're so inclined, feel free to hit that link in the description for a free consultation call. I appreciate you, and as always, see you on the next one.